And Dan and I are 110% behind it because we want to do the same thing. Dan's done the same thing. I'm looking for a home. It's very real, but it's just making sure that we go about it in a way that positions you to be able to take advantage and optimize it and love it. And so that's really, really what I want to hit home, because a lot of this stuff be like, oh, hell no, I don't want to buy a house. This is way too much information. And yeah, it is scary, but that's why you can work with other professionals to make sure that you can do it in a very sensible and optimal way. Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my colleague, Dan Weiss. Today, we're going to be starting off our series, I believe, Dan, right? Buyer beware. We got a lot of different topics on this one, so we'll probably have a few episodes. We're going to try to get through as much as we can, but we also don't want to bore our listeners too much, but also really kind of give some good information regarding some of these topics on being aware when buying. But before we jump in, there is one thing that I want to state. If you enjoy our episode, please like, share, and subscribe to our channels. With that being said, we are going to start with mortgages today. I'm just going to shift gears a little bit because, Dan, you nailed that. It was great. I mean, you explained all that, and just kind of go into a little bit of some of the ARMs, the interest only, fixed, all of those fun acronyms and what they mean. So we'll start with fixed because that's typically the number one that most people do. So a fixed rate means you're locking in an interest rate for a certain amount of time. Typically speaking, people look at a 30-year fixed mortgage, meaning you have 30 years at the same interest rate. And that's pretty much as simple as it gets. You can also do what's called a 20-year. So you have a 20-year time frame with that rate, and a 15-year, which is a 15-year on that time rate. Now, what's going to happen, though, is you're going to pay off those loans within those timeframes. So 15, 20, or 30. Really, most people probably know a 30-year, your payment's lower. You're going to pay more interest because it's not more interest, but you're going to essentially have it paid off with over that 30 years. 20 years, you'll have it paid off in 15. But those payments are going to increase because you got to pay it off in a quicker manner. So that's also something that's really important. Some people will come and say, I want to do the 15-year. I want my mortgage paid off within 15 years. At today's interest rates, Dan and I would push back on that concept. And we'd look at the numbers. What does that really look like? If you can essentially lock in at a 3.5% rate, and everyone's talking inflation's going to explode. Say inflation goes to 5% and you locked in at 3.5%, you're making money. The bank's losing money on that loan. They'll want you to refinance to get you at a higher rate, so they don't lose money on it. So overall, when you're looking at interest rates today, now, if we go back to the 90s when there was 12% interest, yeah, Dan and I would start talking about different things, getting it paid off, utilizing that money in a different route. But as of today, we would push back on that concept in a lot of different realms. Now, again, it depends on the individual, depends on the situation. But typically 30 years make a lot of sense because we can fix it out for that long time and we can utilize that leverage to our benefit. Now, there's other loans such as an ARM. So,
hey, Tim, can I mention something else about that real quick?
Yeah, go ahead. Hit it.
We see all the time. Because I think to stress on what Tim is saying is that, so if you were to go get a 15-year conventional mortgage, fixed mortgage compared to a 30, why people do that is because the 15 years likely, not always, by the way, but likely going to be a cheaper rate. And people get really fixated on the rate. But of course, it's going to come with a higher payment because it's built on a smaller chassis, smaller amortization schedule. And so what we often advise is the flexibility, or at least weighing out the flexibility to the interest saved. And we'll do an analysis on this. And sometimes if the cash flow is there and there's other things at play, maybe the shorter term does make sense to get a little bit better of a rate if it exists. And a lot of times, though, what Tim is saying is it doesn't, because you have to be aware of prepayment penalties, which I'll touch on in a second. But as long as there's no prepayment penalty, there's nothing stopping you from doubling up that cash flow, computing what that looks like, and being done in the same time frame and minimizing most of that interest. But now you have the flexibility where if something does come up, you don't have to make the payment. And
Yes.
like Tim's saying, rates go up, you're making money and possibly in a situation, or you've got more cash flow to maybe reallocate that money elsewhere to make a bigger spread as well. So most time we'll do that in this kind of interest rate environment. If it's 8% rates, which I do think someday we'll see again, that may be a different story. It's relative, but understand that technique. And as far as prepayment penalties are concerned, what that is some lenders in some states will charge you a fee if you pay off that mortgage sooner than what is scheduled. It will depend on the state. So, like for example, a Wisconsin domiciled company it's illegal for them to have a prepayment penalty according to state laws, but it's because it's a Wisconsin domiciled company in a state that prevents that. That's going to be different in all different states, but it's something to always ask and make sure that you're not. It's way too competitive out there to pay somebody a prepayment penalty.
Yeah.
I'll yield, Tim.
Yeah, and Dan brings up I'm glad you brought that up, Dan. And so the idea of where you can get that payment is if you can afford a 15-year payment, you obviously can afford the 30 because it's going to be less. So you can then take that excess payment and add it back to your 30. Typically speaking, if you run the numbers, you're probably paying slightly more interest depending on the rates, but you have the flexibility to cut back like Dan mentioned. And to be honest, 500 bucks, let's say it's 500 bucks a month, just throwing a number out there. That $500 a month may mean a lot. If you lose that job, kid gets sick, something happens. Sounds like a lot, not a ton of money, but it could really make a difference depending on those hard times. And you're getting to the same objective as long as there's no prepayment penalties. So that's where we kind of look at it, is to be able to utilize that loan. Really good point, Dan. We talk about that all the time, and glad you brought that
We
up.
do. And you got to think about your scenario too. So like a lot of times when people are saying, "Oh, I'm going to do a 15-year," Tim just mentioned something that jogged my memory on it. Where cash flow might be more critical is when you do have young children and you're paying for daycare costs, and you are having in different parts of your life. Cash flow becomes more critical. So if you're at a point of your life where it's like, my God, we got to save for this or this, I mean, does it make sense to constrict that cash flow?
And I think the other thing too is when you're looking at it, even retirement. So a lot of people, hey, I don't want to have a mortgage while I'm in retirement. I totally respect that, understand it. But take a look at your mortgage payment though, because what people will come to us and they'll say, oh, my mortgage payment's $2,000. They'll say, well, what's your principal and interest? Well, it really is only actually 800. The rest is taxes and insurance. Taxes and insurance don't go anywhere. Just your principal and interest go away. So you have to look at that number specifically, and what is that really reducing for your overall payment? And is it enough to really make a difference while in retirement? Now, again, I'm not going to say, $700 isn't going to make a difference. And I'm really speaking more towards our Wisconsin residents, just because the real estate prices aren't quite as high compared to California, Salt Lake. But it's something that you just need to take in consideration when you're actually looking at that, is what is the true impact of me paying this off? Because if you live in Wisconsin, for example, I would say is medium to high when it comes to real estate taxes, right? So if your real estate taxes are just inherently large, then it can be difficult to just even have it be paid off, because at today's rates and what you can get it at, you probably could get your P&I so low that it makes a lot of sense to potentially have it leverage, because like, well, this, it's not going to make it or break it necessarily. And that's really just something that, it's just another level of dissection when you're really looking at those two options. And I'm speaking directly towards like more retirees. Another good point, Dan. Always bringing up good points there. To kind of just finish up on the other arms, we won't have to go into too much depth, but we're always happy to discuss it if anyone ever had questions. You have ARMs, so adjustable rate mortgages. A lot of people know of that because of the Big Short in 2008. So what happens is you can do what's called like a 7-year ARM. So what that means is that your rate's going to adjust on that 7th year. And once that 7th year comes, you essentially essentially refinance. And then whatever the rates are at that time, you have to lock in at new rates. It can adjust on a month, 6-month basis, a year basis. Depends on how the ARM is structured. It also depends if it's a conventional loan or if it's a jumbo loan. Quickly on that, conventional, it means that it's typically backed by the federal government. If you go above that, it's going into the jumbo loan territory. It differs between states on the limit. Then you're looking at private backers or private investors who are going to give you that mortgage. So it just depends on if it's a jumbo loan for an ARM or if it's conventional ARM. But you have to be very, very careful because those rates can adjust. And if they adjust, it can turn really south on you where you may not be able to afford that payment. That is actually a lot of the reasons or a lot of one of the impacts that really caused 2008 was a lot of ARMs that were poorly structured and people just didn't probably quite know what they were in. In addition to that, you can even do what's called an interest only loan. So an interest only means you pay only the interest. Please talk to a professional before you do that. It's probably not a great idea. Now, where to kind of give our listeners an idea of where it may make sense, again, depends. I'm going to use that a lot. It depends. Is typically investment real estate. If you're trying to flip something, if you're trying to get out of it, get in, get out, that can make sense. You can use that leverage to be able to flip the house. Now, even that's risky though, even as an investment standpoint, you have to be very cautious. At today's rates, hard pressed, because your overall cost of that loan, even to flip a house, is so low. Again, talk to somebody about it, run the numbers, see if it makes sense. Don't take on that undue risk if you don't need to. But again, it depends, may make sense for some. Those are typically the three big guys that come through. And that, that really are. But again, on each of those, it depends on what you should do. So fixed 15, 20, 30, ARMs 5, 7, 10, interest only. It all depends on your situation. And you really should be talking to somebody to help you understand your situation very clearly, educate you on it. And to be very frank, it's not going to be the lender. It's not their job. It's not what they're interested in doing. Don't look at a lender to tell you. Also, CPAs probably aren't going to tell you either. They may tell you the advice of what they've done at their own house and what they think they should do, but they're not looking at all the details. You really should be looking at, working with somebody that is going to take a deep dive into your cash flows, understand what's going on, understand if you can or cannot do it, and they should be educating you on all the scenarios. And you should make them say, I want to look at an ARM. Run an ARM, see what it looks like, and then see how it affects you. I want to do interest only. Run that, see what happens. But you should be running the numbers, you should be looking at it, and you should be seeing the impact to your overall household finances. And that really goes down to a cash flow and then understanding how much you have for a down payment. So that's what I got on that. No, it can be very advantageous.
It can, because they usually come at a lower rate in theory than a fixed mortgage. And that's what can attract people. Or maybe you're going to take advantage of a lower rate because you're not going to be in the house for more than a couple of years. That could be risky because you could be wrong about that. Or
we've had people that have done, we've had some really good ARMs, but what we've talked about, like Dan just mentioned, is you got to be in the mindset, you got to get out of this house.
Right.
And do you want to be put in a position to have to sell?
And it could be a situation too, where we're in a high interest rate environment and we expect those rates to drop down. But the house, you're not going to wait 7 years to buy the house. You buy the house now, feeling like you're going to drop it, and there's risk there too.
But the hard part with it, even if we're looking at interest rates to like come down, the hard part with that as well is even because we've seen the refinance boom. You can always refinance. Yes, it's going to cost you to the potentially an appraisal. It's going to cost you closing costs, but depending on how low the rate is, it can make a lot of sense just to do that. And then what's been really cool, at least locally, is there's some banks that have gone to like express mortgages for these refis because it was been so hyped up, where you can remove a lot of these costs. And man, we got some sweet deals on the express mortgage side of things. But again, depends on the individual. So even with an ARM, be very cautious because you may refinance out of that 5 or 7 year anyways before it even gets to the lower rate.
And actually, that's a really good lead into a softball I'm going to throw your way, Tim. So a lot of this conversation is going to revolve around closing costs, which, buyer beware, you got to ask about closing costs. It's different in different areas from a commonality standpoint, but they can range. Like those express mortgages Tim's talking about. If you're local, Summit offers a great product in express mortgages. Depending on the loan size and the loan to value, no closing costs.
Yeah, good deal.
A great deal. And you could have the same loan, and someone might say the closing costs are $1,200 or $5,000 or whatever be the case. Also, be careful, because what we'll see people do is you might pay, actually, the closing costs might look different, but they maybe up the rate then to make up for some of those closing costs, or vice versa. You've got to look at it comprehensive. It's not easy to necessarily do. And from the ARM standpoint, which is what made me think of that, is it's a forced refinance. 5 years from now, you're refinancing, you're likely paying the closing costs again, something else to factor in. And that brings me then also, unless Tim, you've got things to add generally in the closing costs, one particular thing that I think gets confused a lot, and again, not good or bad, none of this is really good or bad, it's how you use it and how it applies to that specific scenario, is points. We get in a lot of conversations where we'll get it with a lender, and the lender might be very, I'm against points, period. Or I love points and I offer points up and push them all the time. And again, situational. Points could make sense, but I'll yield there. Maybe Tim wants to explain points and under what situations it makes sense. We see it all the time.
So points are really interesting, and you have to kind of look at them from the standpoint, like Dan mentioned, it depends. It can depend on if it's beneficial to you or not. Typically speaking, 1 point means a percentage point of the overall loan total. So to make math easy, let's say you have $100,000 and you want to buy 1 point. That would be $1,000 that you would need to put down in order to potentially lower your interest, because what you're doing is you're essentially kind of fronting interest payments. You're kind of prepaying your interest in all reality. So you're going to put some money down today in order to lower the cost. That lowering the cost lowers the overall loan total over the time frame, because it's not as much as compounded over that time. Because amortization schedules are compounded interest tables or compound interest structures. So you're adding interest over time. So with that being said, if you're looking at buying points and you're saying, okay, they're offering me 3% with no points down, so I don't have to bring any money to the table to buy it, or I have to, I'm going to get an interest rate at 2.5%, but I have to, do 0.8% of a purchase of points, right? Does it make sense? Does it not make sense to bring that cash to the table? The reason why that question depends is it all depends on the size of the mortgage, how much you're reducing your interest. Do you have the cash to even do it? Does it make sense? Does it not? And which I highly recommend is run the
house.
Yeah, how long will you be in the house? Is it you're gonna get your costs back? Are you not? Just kind of overall looking at that. Is it going to position you in a better way where you have more cash flow? How much more cash flow is that? Could we take that cash flow, add it back to the mortgage to pay it down? Right? It's that one question is really a ripple effect across kind of understanding and analyzing if it makes sense or doesn't make sense to actually use cash today to purchase those interest rates. Depending on this, and it's really depending on the size of the loan. Smaller loans, just because the percentages aren't as big, right? The dollar amount equivalent isn't the same. Now, with clients in New York, California, San Francisco, buying points can actually make a big deal because you're looking at a larger, an absolute dollar value, just a bigger dollar amount, right? So if you're looking at 1% of $1 million versus 1% of 200,000, that's just going to create a lot of, or 0.5% for a decrease in interest rate on that size of a loan. Dan and I may say for the $200,000 person, not really. It may not make sense. All of a sudden, you throw your loan up to $1 million, and it's like, well, yeah, 0.5% over 30 years, it's gonna make some difference. We maybe should think about this because paying that up front may make a lot of sense. So it really is dependent. I don't think there's a right or wrong answer with buying points. So as Dan mentioned, pushing points or not pushing points, I think it's just, well, sure. If you want me to, if I can look at it, I'll take a look. I'll do the analysis, see if it makes sense. And if it makes sense, I'll do it. And if not, I won't. And it's not just always all about well, you'll decrease your payment by $50, and that $50 a month is then going to add up and you'll get it paid back by X time frame. It also is, do I have the ability to put $5,000 down? Maybe I don't. Maybe that needs to go to some of the furniture because I just bought my house. So again, it's just taking that, that the holistic approach to that one question, which hopefully if you're working with a professional, they can help you kind of guide you through that answer. I know that we can, but I don't know that everybody will, but we definitely do that for our clients to make sure that we're making the most optimal decision based off their current scenario, looking at all angles.
A couple other tidbits we just kind of want to hit on that we're seeing really today. We're seeing the last couple months, more so than other time periods in our career. One we mentioned, and talk about the cash offers. That's not uncommon or new in a state like California, for example, where I feel like most of the people come with cash. It's crazy, right? But we're seeing that in other areas too of the country where it's not as common. So how are people doing that? Well, some just have the cash, no doubt about it. But do most of those people have that cash laying around? No. So I know how they're doing it. Well, here's one way a lot of them are doing it. They are leveraging. They're taking a loan, refinancing their current home, pulling out what's called a cash out, pulling out the equity in the house, which means they're paying the closing costs to refinance that house, and usually a bit of a ding on the percentage for doing the cash out, taking the cash in hand. Then they're going to the new house and saying, I got this cash, I'll buy this in cash. They're really robbing Peter to pay Paul, and they're paying basically Peter a fee to do so, right, in the closing costs. And then what's happening is once they get the new house, they're crossing their fingers that they can sell the old one and break even with closing costs that they have to pay to sell the home, possible realtor fees they got to pay to sell the home. And they're hoping that they can then basically walk away clean, or they're refinancing the home once they get in there. If that happened last week, you might have been okay doing that. But at some point in time, some people are going to get fried on that because the values will start changing. If you're looking at different markets, that's not equivalent. That's dangerous. If you can't sell that home, which I know seems really weird this week, for example, but that could happen, especially if it is a larger home. I mean, if you're looking at a mid-market price for a house, it's probably moving pretty quick. But if you're looking at a $2-3 million home in most parts of this country, there's just not enough buyers. There's not enough buyers compared to what a $250,000 house might have. It may not move as quick. So understand that tactic, although can work, it is not without its risk. So if people are telling you to do that, or no one's telling you, you just think it's a good idea, you might work out and be fine from an outcome standpoint, but that's scary. But another one, and Tim might have some others to add or not, but another one that Tim and I have been talking a lot about too is the removing of contingencies in buying a house. Okay, so there's some common contingencies. For example, finance contingency, meaning that you go into the house and you say, oh, I will buy this house as long as I can get financing. But if my financing falls through for whatever reason, I have an out on this deal. And we've seen a lot of people remove those financing contingencies, of which case, I mean, creative realtors, intelligent realtors, of which we know many of these people, might recommend something like that because it is competitive. It's highly competitive right now. And the seller doesn't want you to fall out because they might say, oh, well, we can get you out on an inspection, for example, right? So you maybe don't get this contingency. We'll get you out in here. Okay. If it's a good realtor, and you can waive that if it doesn't work out that way, financial contingencies are not likely to fall through, whatever, I can get behind some of that. But here's one that has come up recently where I don't know. I mean, I personally, I think this is absolutely berserk. Waiving the inspection. We've seen a lot of that.
That is
Whoa.
very common in today's day and age. Which in waiving the inspection, essentially you don't do the inspection, so you're kind of on the hook depending on what comes out during the due diligence process. You technically can't do inspections until after it is actually bought, so until you close. The other thing that too is crazy is appraisal contingencies. So what's been happening because the real estate prices, again, as of today, have gone up so high, what will happen is depending on the bank, if the bank comes back and says, you just purchased that house for $500,000, we appraised it for $450,000. We're not going to approve the loan for $500,000. It's going to be at $450,000. You got to come to the table with an extra $50,000, and that's on you. And you got to do that. So that's very, very real. So you got to understand if you're going into that, how much cash you're actually going to put in and what you feel that you can actually do above the appraisal cost. The other crazy, the appraisals. And then the other crazy one too is typically speaking, with inspections, some realtors are also doing amendments, being able to, on the inspection side, saying, okay, we'll require an inspection, but let's do a floor. So if, for example, you say, I'm not, if the inspection comes back and there's anything under $5,000, I'll cover it. Don't worry about it. Anything above $5,000, we're going to renegotiate. But I'm going to cover anything $5,000. So if it comes in at $6,000, something happens, you can only get $1,000 back. Can't get $6,000 back. So there's just, and that's being quote unquote conservative relative to just saying, hey, you don't need to do the inspection. I'll just buy the house, which is crazy. So there is definitely a lot of different things to take into consideration. The reason why Dan and I bring it up, we're not realtors, but what we are is we're looking at trying to make sure that we can finance this and what potential people can be on the hook. Because again, houses may look pretty, but they have issues. They have issues, and we have to take that into consideration because those issues are going to come out of your pocket. So it's again just taking a look at the whole picture and not just buying of the house. For my final thoughts, honestly, Dan and I talked about a lot of things. We always seem to be the bearer of bad news all the time, right? We're always the ones that saying, don't do that. Is that rational? Is it not? But what I do want to say is that what's very, very real and is sometimes underestimated when getting a mortgage, which means you're buying a home, is that homes do have value. And where homes have value is the qualitative sides. It's something that you own. It's your own space. You don't have share walls with somebody. You have a yard. It's in the school district that you want to be in for your kids. You create memories. People come over, you entertain. And all of that is an emotional return. That's what it is. And that's why you buy a house. But what we're talking about is when people go in to buy houses, how can we optimize that emotional return? How can we optimize the ability to get in this for you to make sure that you're positioned to take on different markets, different situations, changing of interest rates, right? Things change, things go up, things come down. And so what we try to do is prepare you and prep you with all the information today to make that wonderful decision, which is owning your own home, which may be starting your own family. And so you can start creating those actual memories. And Dan and I are 110% behind it because we want to do the same thing. Dan's done the same thing. I'm looking for a home. It's very real, but it's just making sure that we go about it in a way that positions you to be able to take advantage and optimize it and love it. And so that's really, really what I want to hit home, because a lot of this stuff be like, oh, hell no, I don't want to buy a house. This is way too much information. And yeah, it is scary, but that's why you can work with other professionals to make sure that you can do it in a very sensible and optimal way.
That's a great point. I don't know if I like following you on closing thoughts.
I always follow you.
uh, it's well said. I mean, money doesn't mean anything, right? If you can't make your quality of life better and those around you. We say that all the time. And this is not just a decision about money. It isn't. But money is a factor, and so it should be considered. I guess for just some last thoughts on my end, uh, I'll go back to my disclaimer. I actually think I'm going to probably have a very similar thought to the rest of this series too. But I'll go back on my disclaimer. If we pissed you off and you're a consumer, then we really are sorry, because there's just not enough education about this. There's not enough resources. Maybe you didn't think to ask. Maybe you were giving bad advice. Maybe it was fine advice but not applicable to you. And maybe you're hearing this and you're saying, "Dang, I wish I would have known that I'd done that different." For that, we are truly sorry, and don't mean to be harsh on any of that stuff. That's not on you or not solely on you. But now, hopefully, if you are a provider of these services and violating, meaning that, not to say, again, none of these are really wrong, but if you know it's not appropriate and you're pushing that, and we've pissed you off, I'm not sorry. In fact, you should be ashamed of yourself, and we probably don't like you. So that is totally okay. So go ahead and hate us. Outside of that disclaimer, risks are very tough. Risk management is really hard because it's kind of invisible, right? Like, people don't understand risks, so they ignore them or they discard them. Everything we talked about has different levels of risk. There are ways to better understand risk. It's not an easy thing to do. Don't just discard it or ignore it. It's present, whether you feel it or whether you don't. And the other piece I think that I'm going to say throughout this entire series is that keep in mind that there are always incentives. So you may have the most ethical person in play, and hopefully you do, and there's plenty of those out there. But there are incentives, and that's not to be ashamed of, or just to be aware of, right? That people are designed to do things for certain reasons, and you could either have a mortgage salesperson, or you can have a mortgage educator, a real advisor. Same with a realtor, which goes hand in hand. Same with somebody like us. So just pick the right person, press on that, and be open to learning. And that's how a buyer becomes aware. That being said, we wish you all a great night. Thank you for listening to us have this conversation. More to come, and we hope you join us next time. Take care.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,